Hey everybody, welcome. Today we're going to talk about a very specific circumstance, one of my clients. This will be a real situation. Obviously I'm going to change the names and some of the details. This happened probably almost a year ago now. And we're going to call her Sue, and we're going to talk about how Sue bought her house. We're going to talk about what Sue was looking for and how she started that journey and what happened during her search process. There were some interesting things there, making the offer, and what she did to close her loan, and then finally a little bit about that loan payment and details. So anyway, let's go ahead and get started. First of all, Sue came to me. She was super excited. She was a first-time home buyer, and she had kind of a unique situation because she was asset rich but income poor. Now when I say she wasn't literally poor. She had a good steady job and decent income, but the assets she had accumulated far outstripped her income profile. Now, that was interesting in and of itself because as lenders, we're required to be on the lookout for money laundering, right? And so we're required to be on the lookout for situations where things don't always line up the way they typically would. And remember, there are no real typical situations. But whenever we had this kind of situation, that actually ended up slowing down the process a little bit. Underwriting had to do a little bit of extra legwork to make sure that the funds were legitimate, that they weren't laundered money. So anyway, that's a little bit of an aside, but she came to me and she had substantial assets. She had substantial assets. Her price range was about $650,000, and she was going to buy her first home. And she was young, and the reason that she came to me was because she had lost out on a house already. She'd been working with a realtor and she lost out on the house. And one of the reasons she lost out on the house is she had been to a local credit union and they would only approve her for $150,000. And they were requiring her to put virtually all of her assets on the table to buy the house. We're talking $400,000 into the deal and they were going to loan her $150,000. And that wasn't really a good situation for her. She wanted to hold on to her cash. She wanted to hold on at least some of her cash, and she wanted more house than that. She wanted to qualify for more house, but they capped her out at $150,000. And this is really kind of the first step in the process, and we just kind of call this pre-qualifying. Sometimes you'll hear terms pre-qualify, pre-approve, pre-underwrite. And there's a lot of variation in the industry of how those terms are used. But generally speaking, a pre-qualification, when I do it, when I think about it, is just having that initial conversation with my borrower and getting a general sweep of their overall financial picture. What kind of income, what kind of assets do they have, what are they looking for? It's kind of that big picture. And that pre-qualification step is really important because it helps to identify, where are there any potential problems? It helps you anticipate problems there. It helps you to anticipate documentation needs that you're going to do. It helps you fix problems. Sometimes by just having that initial conversation, maybe months even ahead of when you're going to really start seriously looking, you can have enough time to fix problems. You have credit problems, or there's a certain way that you need to structure your financial profile in the next 3 months that's going to make a difference. That can happen. And so that's kind of the initial process, and that's really where we started with Sue. Sue came to me, and we just talked, and we said, okay, we talked about, sorry you lost that house. They only qualified you for $150,000. She was looking to buy $650,000. They capped her out at $550,000, and they were going to take $400,000 of her cash. And so we talked through that, and we pretty quickly realized that there was an opportunity here. And in her particular situation, what that involved is I helped her become a self-made trust fund baby. That sounds kind of like an oxymoron, right? What's a self-made trust fund baby? A trust fund baby just kind of inherits a bunch of money, and that's how it works. Basically, she came with a lot of assets, and we were able to annuitize those assets and turn it into income. Rather than using that for down payment, she was only required to bring about $100,000 to the closing. I think it was $150,000 of her assets to closing, preserve the rest of that asset, which is what she wanted to do, and qualify for much more. And basically it was because we were able to use her stable job, so we used her job income, and then we annuitized part of her asset base. And again, that was an interesting, unique little situation, but it was one that the credit union wasn't familiar with, wasn't willing to do, and we were able to get that done. So we got her approved, and in this situation, the next step after pre-qualifying, you're going to get pre-approved typically. Now, pre-qualification is just having a conversation with a loan officer, someone who knows a little bit about what they're talking about and can evaluate your situation kind of at a high level and say, yeah, I think you can get there. Now let's dig into the details and figure that out. And sometimes you do a pre-qualification and you find out somebody is just really well qualified. They've got a simple job, they're salaried, they've got very objective income, easy to verify, they've been there forever, there's nothing variable about it, there's no bonus, no commission, no stock income, it's just very straightforward, and their objectives are well within their means. And sometimes that's enough to kind of launch that buyer off into their shopping. Now I still recommend pulling a credit report, verifying the income with pay stubs, doing that kind of stuff, partly because the listing agent is going to care about that. Even though I may be able to tell the listing agent, look, their situation is so clean, so straightforward, there's not going to be any issues here. They still want to know that they've been verified. But that's the kind of situation where it's that straightforward. You go from the pre-qualification to saying, yeah, you can go out and shop on that. And I, very rarely, maybe I'll even issue a pre-approval letter on that, but I almost always will require we pull credit. As a very minimum, we're going to pull credit because you never know what's on your credit report. Most of us don't have access to our own credit reports that we can see on a regular basis. And I know that's changed a little bit over time, and we get notifications when different things happen on our credit, and our credit card companies give us some of that. But none of that really gives you a mortgage credit score. And so that's the very first thing I would do with someone. Once we did the pre-qualification, then we step into the pre-approval status. Now, in the case of my borrower, Sue, her situation is, we were using this little, some people would call it kind of a loophole in the guidelines. And that's why a lot of people don't understand it or don't really know it. And it is somewhat of a loophole, and because of that, I always re-verify this with underwriting before I actually issue a pre-approval letter when I'm depending on this little scenario. And that's just because my sense of it is that at some point Fannie and Freddie are going to clarify the guidelines, and maybe this won't be available anymore, and it won't enable us to approve people with this kind of scenario. And so in this situation, because I knew it's a little bit nichey and because I knew not everybody knew how to do it, I wanted to make sure the lender I was depending on to take this loan actually was going to buy into the way I was presented. So I got this formally pre-underwritten before this client went out in order to make that solid offer, because that does two things. One, again, it gives me great confidence to be able to tell the listing agent, yes, this deal is going to close. I've already been to the underwriter, but it also enables me to close quickly, right? It also enables me to go to my buyer and say, look, if you want to have an edge in this offer situation, you're in a competitive offer, you can offer to close very quickly because we've already worked this all out with underwriting. We know what we're going to do, what we're going to need, what documents we're going to need. We know they're going to accept them. And so we just need to put the paper in the file, and this is going to go fast. Sometimes my borrowers come to me and they need a recommendation to a realtor. And that's super important. We really strongly advise you bring your own realtor to the table. Never, ever use the selling agent's realtor when you're buying a house, because that selling agent or that listing agent is contractually obligated to get the best deal for their seller. How are they going to possibly do that in a manner that preserves your best interest and their contractual obligation to the seller? So I would never ever use the listing agent for yourself. Bring your own realtor to the table. Once you have your realtor, in this case, Sue came to me after she already had a realtor. They had already lost out on a deal because her credit union couldn't qualify her, and that's why I got involved. Very interestingly, it was one of my realtors. I think it was the home that she lost out on. He was the listing agent on that home. She lost out on that, but they really struck up a good relationship. My realtor, who was the listing agent on this home, and this borrower, and they really liked my realtor, and he referred them to me. He said, well, look, I know you're working with a realtor, so you keep working with that realtor, but you go ahead and call Chris, and maybe he can get you approved for more. Turns out we could. Once you have a realtor, you're out there shopping, you're going to go out there and you're going to look at different properties. And this is one of the services we like to provide is when you're out there shopping, to send us, when you see things that are of particular interest to you, send them to us. Send us the listing, send us the listing, the Zillow or wherever you're finding those listings, send us that property and let us know, okay, I'm kind of interested in this property, I'd be willing to pay list price for that. Can you update my numbers and kind of tell me where we'd be? And the reason we want you to do that for specific properties, so one, if you are very, very tight, again, on the debt to income limits, or if your underwriting approval is just really razor thin, you don't have a lot of cushion if anything goes wrong, if underwriting comes in a little bit lower in income, then you definitely want to do that because interest rates change every day, right? Interest rates change every day, and so different day, different interest rate may require a different answer, for that specific property. So you want to be updated there. Also, county real estate taxes. That's a fairly big number, and that number can swing, fairly significantly. And that's something we can know on specific properties. We just look up the county record, and 95% of the time we can get a specific county amount. In the state of Washington anyway, that's not true in all states. But in the state of Washington, you can look up the county record in almost any county. You can get the specific dollar amount of real estate taxes, and that's a fairly significant component of your monthly payment. And so we want to update those two things. What's the purchase price is one of the things, and then what are the county taxes, what are current interest rates, and rerun your numbers. And we always ask our clients, go ahead and send that to us. The other thing we want to do is we want to take a look at the specific property they're interested in, because sometimes there's subtle clues in the listing notes that may hint at some problems, and we just want to be aware of that. Most of the time, the vast majority of properties that are out there on the market are financeable as is, but sometimes they're not. Or sometimes there's some things that just need to be addressed in the negotiations to make sure that they are. And so that's why we encourage our clients to go ahead and send us everyone. So your buying agent writes the offer, and generally they're going to include my pre-approval letter with that. And they're going to reach out to the listing agent and say, oh, by the way, here's the lender, and the lender's ready to talk to you. And that's really vital. That's really vital in just about any market, because, again, realtors have been burned. They're there to protect their clients. They're also there to protect their own income. They want to make sure that loan closes. And they've been burned many times. People come to them with pre-approval letters that just ultimately aren't honored because mistakes were made or people were just careless. Whatever happens, things don't go as they expected based upon the pre-approval letter, and they want to make sure that their client gets a real deal. They also want to make sure that they're working with a loan officer or a lender who's available during the transaction. Because the other thing that can happen is, deals will get done, but it really is like this big black box during the whole process. They accept the offer, the seller accepts the offer, the contract's written, and then the seller doesn't hear anything, can't reach out. They're working with a call center somewhere in the Midwest, and it's a different person every time. They can't really grab and hold and touch someone and say, how's the loan going? What's the next process? Are there any problems? Are we going to close on time? They like to know, and they like to know every week. They like to know every week that you're working on that deal, that your lender's working on the deal, everything's on track. That helps them do their job for their seller to make sure that things are going well. So you get under contract. You then would turn the loan, basically give the contract to your lender and say, okay, we're ready to go. In this case, we had pre-underwritten this, as we talked about for Sue, so she got under contract. We went in with a relatively fast close because we knew that was attractive to the seller, and we went right into underwriting. I'd like to say that there was zero hiccups on Sue's deal, but there was one hiccup. I had actually, generally when you do this annuitization process, you have to sustain income for 36 months. That's the underwriting guideline, is you can use an asset base for income over the course, but it has to be sustainable for 36 months. So if you need $1,000 a month, you need $36,000 a month. And if you need more than you need $36,000 to sustain $1,000 a month for 36 months. But in this case, it actually turned out that this is kind of where the subjectivity comes in. Most underwriters, you have to have 36 months, and one of those, you have to have at least one draw under that plan before closing. And in this case, so we did our 36 months, we took the one draw before closing, and underwriting came back and says, well, now that you've taken the one draw, you don't have 36 months left at closing. And so we scrambled and we got it done. We redid the deal. We took the remaining assets, we divided that by 37 months. We took one draw and we had 36 left at closing. But that was an underwriting condition that came back. So we submitted the file to underwriting. We included all the documents, and they came back and they said, okay, this is all look fine, but this number, we need this sustainable for 36 more months. You've taken one draw, it's not done. That's what you call an underwriting condition. And there's always going to be some miscellaneous conditions. I mean, most of if you get a really clean deal, you can go in and out, and our average clear to close from contract, submit the loan to underwriting to being clear to close, which is when loan documents happen. That typically happens in about 2 weeks or less. and it can go faster if you're primed and you need to, but 2 weeks or less is just average, for us. That's typically how that happens. So we get conditions that come back. Now, usually the underwriting conditions will come back sooner than the appraisal. The appraisal is usually the thing that holds you up the longest. In our market now it got bad during the height of the refi craze. Things were taking longer. But in this market, typically we can get an appraisal in and out in about a week. But we can get underwriting in and out in a day. So we submit the loan for underwriting, comes back with conditions. In our case, we had that one condition, and then we had to wait for the appraisal. So we waited for the appraisal. It was done in about a week. And then once underwriting has satisfied themselves, they said, okay, we see you've got your electronic approval from Fannie and Freddie, and we've got the data that validates, or we've got the documents that validate the data that you provided the underwriting engine to give you that approval. So this is a good loan. We're just waiting for the appraisal. The appraisal comes in, they clear the appraisal, and now you're what's called clear to close. Clear to close basically means the underwriting has cleared all of the relevant documents. They are ready to prepare actual loan documents. Loan documents are what you sign, and usually loan documents are 70, 80 pages. The vast majority of that is just, it's just kind of blah, blah, blah. It's government disclosures meant to protect you, but it's the kind of stuff where, you get an insurance, you get a mailer from your insurance every year that says, oh, we've updated our privacy policy. But you're going to go to escrow, you're going to sign your loan documents, and at that point, escrow is going to, in our state, we are an escrow state. Some states, you all go to the attorney's office, you sit around the table with the sellers, the buyers, all the realtors, everybody signs at once. That's not how it typically works in our state. In our state, we're an escrow state, and so escrow is that third party that is independent of the transaction, independent of all the parties in the transaction, and they're responsible for making sure that all the opposing parties' interests are satisfied. And so typically in a finance transaction, you have a seller, you have a buyer, and you have a lender. Okay, and those are the primary interested parties. And so the escrow takes the contract, they read the contract, they say, okay, I see that, seller, you had the obligation to do this. Buyer, you had a final walkthrough that you were going to do. Everybody says, yeah, all of my conditions are met. The lender says, okay, here's the loan documents. Make sure they sign all the loan documents. And once they've signed all the loan documents, then we will wire you the funds. And that's what really escrow's job is. They take these documents, they bring you in to review and sign everything, and then they let lender know, hey, we've satisfied your conditions, send us the wire. And that's what happens at closing. The lender will send the wire on the day the transaction is meant to close. They'll get the wire, and then escrow disperses the funds according to everybody's instructions, and you become the owner of this home. Now, in Sue's case, we ended up with a loan amount of $410,000. We had a rate of 5.866. Now, this was early 2023, so I'd like to say that my rates are that much lower than the prevailing rates right now, but they're really not. They're good. They're good. Don't get me wrong on that, but not that good. Monthly payment was $29.25. That was everything included. That was taxes, insurance, and everything. So here we closed in February of 2023. And this is another little wrinkle some people aren't aware of is, the first payment, when typically you're going to skip your first mortgage payment. Mortgage payments are typically due on the first of the month. And what happens though when you when you enter into a loan in a particular month, let's say you close middle of the month, the lender doesn't have time to get you in their system, to send you a statement, to have you make payments, and all that happened by March the 1st. And so the lender says, look, we're going to skip March the 1st. We're going to start you with April 1st. So you get a little bit of a reprieve. Now you're paying interest from the day you get the loan to the end of that current month. It's not like you're getting free interest or anything during that time. All of that's factored into the funds that you need to bring to the closing table to make sure that everybody is made whole. But you do get a little bit of a reprieve, and this is particularly true if you're a first-time home buyer going from a rental situation, because typically you prepay rent, right? When February's or March's rent comes due, you're paying that March 1st. But if you don't have to make a payment March 1st because you've closed on your new house, and you don't have to make a payment on your new house until April, you get a little bit of a month, which is kind of nice, a little bit of a cash flow reprieve. I get questions from all over the country from some of my videos And I'm licensed in Washington and Idaho, but I'm really happy to answer questions, and I can refer you to loan officers in your, in your market if I'm not financed there. So I'm happy to answer any questions that you may have. Feel free to ping me. But subscribe, like, and let me know if you have any further questions. Thanks so much.